Circular financing, negative free cash flow. Does the tech sector have some major issues, some major problems? Hello, friends. Welcome back to another video update. We are going to answer those questions. You may have seen in the news recently some of these concerns for the stock market and specifically tech. So let's start with circular financing. What is it? This is when money is lent or invested out to a company and then comes directly back to the original investor through purchases or other transactions. Let me give you an example. Let's say I want to open a lemonade stand. I need to borrow $100 from my friend Bob. Bob conveniently owns a lemonade supply company. So I turn around and buy $100 worth of lemons, sugar, cups, everything I need from Bob's store. Bob then gets to report $100 of sales. And maybe I do go sell $300 worth of lemonade and pay Bob back the $100 plus interest. But you see what happened. It's a little bit, the revenue, the profits, it's a little watered down. You see what I did there? Lemons, water. Okay, anyway, you'll get that later. Here's how it goes in tech. Large tech firms invest in AI startups. They go buy cloud services or hardware or something like that from the same companies, and it creates a loop. This can blur demand signals that we track, but the industry growth appears driven by genuine demand for AI. We would know if all the demand was circular, and it's not. It's broad-based. The phenomenon I just explained is being monitored. I want you to know that. And yes, we like the organic growth. And yes, we like organic lemons too. But so far, this dynamic is not seen as problematic. Okay, what about negative free cash flow? What does that mean? Free cash flow is just the cash that companies have left over from their revenue after paying their business expenses and their business investments. The largest hyperscalers out there, you may have heard this new word, Alphabet, Amazon, Microsoft, have a major business investment going on right now for their future. Data centers. It's all over the news, data centers. We call this big business investment CapEx. It's a cool way of saying capital expenditures, CapEx. As much as $750 billion with a B is expected to be spent on data centers, this infrastructure in 2026. That's a lot of CapEx. And yes, it is eating up their free cash flow. So it can go negative, and it's starting to go negative for some companies. Normally, we don't like to see negative free cash flow. But in this case, companies that have awesome net cash from operating and they're putting that money into their future via data infrastructure, and the demand already exists, it's not hypothetical, it's not going anywhere, we're okay with that. Most of this negative free cash flow is funded by debt issuance. Again, that's not a bad thing. It's been around for a long, long time, helping to fund growing companies. So think Netflix or Amazon. It can pay off in a major way, even if you go negative for a little while. So to summarize, yes, there are some concerns out there, some very interesting dynamics going on. We're watching it closely. We'll keep you posted, but we don't believe it's the end of this cycle. We don't think it's bad news at this time. Time will tell. Hope that helps explain some of these things. Have a great night. We'll see you next time. Bye.